And thanks for continuing on with us. My name is Ibrahim Sani, taking over from my colleagues Nina Rozman as well as many others on this morning. The issue here is that my voice is still coarse from the World Cup, but the job must be soldiered on. So we start off with the international markets, beginning with the US. This is because Wall Street closed slightly higher yesterday after 4 sessions of declines. But investors fretted about weak holiday shopping and rising bond yields added pressure after the BOJ's surprise tweak of monetary policy. Fears about the Federal Reserve's plan to keep raising US interest rates have weighed heavily on equities since its policy meeting last week. Adding pressure was an increase in the US Treasury yield after the BOJ made a surprise tweak to its bond yield control that allows for long-term interest rates to rise even more. Investors were also worrying about the current quarter earnings season and winter holiday shopping. The Dow Jones rose 92.2 points or 0.28%. The S&P 500 gained 3.96 points or 0.1%, and the Nasdaq added 1.08 points or 0.01%. Among the S&P 500's 11 major sectors, the energy index gained the most, finishing up 1.52% as crude oil prices rose. Of the 4 sectors that declined, consumer discretionary was the weakest, finishing at 1.13% down. And of course, in other news, corporate earnings growth is expected to slow in the year. This is because many countries as high as inflation and rising interest rates take an even bigger toll, and companies brace for the likelihood of a global economic downturn in 2023. The US companies are forecasted to have the slowest full-year profit growth since 2020 and the start of the coronavirus pandemic. Some top equity strategists predict no profit growth or even a decline in earnings. Investors have been watching estimates fall in recent months. The S&P 500 fourth quarter 2022 earnings now are expected to decline 1.1% year-on-year, which would be the first quarterly earnings fall since the third quarter of 2020. For the US benchmark S&P 500, analysts project full-year 2023 profit growth of 4.7%, following the estimated growth of 5.7% for all of 2022 based on Refinitiv data. Jonathan Golub, chief US equity strategist at Credit Suisse Securities in New York, recently lowered his profit forecast and expects a decline in year-over-year S&P 500 earnings for next year. The S&P 500 consumer discretionary sector is expected to have the highest year-on-year earnings growth in 2023, with a gain of 30.3%, while the energy sector is expected to have the biggest year-on-year decline in earnings. Rising rates have especially hurt technology and other growth shares this year. The tech sector earnings are expected to gain just 4.3% next year over 2022, and Golub and others said that may be too optimistic. European company earnings are forecasted for a sharp slowdown in 2023 after a strong, formidable few years of growth since the pandemic slowdown. Based on a Reuters analysis using 5,756 companies across the globe with a market capitalization of at least 1 billion each, earnings growth is seen slowing at about 4.0% next year from 4.9% this year. So we're talking about BOJ earlier. The BOJ shocked markets yesterday with a surprise tweak to its bond yield control that allows long-term interest rates to rise even more, a move that is aimed at easing some of the costs of prolonged monetary stimulus. Shares tanked while the yen and bond yields spiked following the decision, which caught off guard investors who had expected the BOJ to make no changes to its yield curve control. This is coming after the BOJ Governor Haruhiko Kuroda steps down in April next year. In a move explained as seeking to breathe life back into a dormant bond market in Japan, the BOJ decided to allow the 10-year bond yield to move 50 basis points to either side of its 0% target, wider than the previous 25 basis point band on either side. The central bank kept its yield target unchanged and said it will sharply increase bond buying, a sign the move was a fine-tuning of existing ultra-loose monetary policy rather than a withdrawal of stimulus. Kuroda said that the move was aimed at ironing out distortions in the shape of the yield curve and ensuring that the benefits of the bank's stimulus program are directed to markets and companies. The BOJ also said that it would increase monthly purchases of government bonds to 9 trillion yen, or about 67.5 billion US dollars per month from the previous 7.3 trillion yen. Meanwhile, U.S. Consumer Financial Protection Bureau hit Wells Fargo and Co. with the watchdog's largest ever civil penalty on Tuesday as part of a 3.7 billion US dollar agreement to settle charges over widespread mismanagement of car loans, mortgages and bank accounts. The consumer watchdog ordered the bank to pay $1.7 billion of civil penalty and a further $2 billion to redress more than 16 million customer accounts affected by the violations. The bank illegally charged fees and interest on auto loans and mortgages and had cars wrongly repossessed and imposed unlawfully surprise overdraft fees, among other issues. Shares of Wells Fargo were down about 1% in early afternoon trading. The CFPB and other regulatory banking bodies have taken multiple enforcement actions against Wells Fargo, including consent decrees that legally compel the bank to redress and address violations across its business lines. There are currently 9 open consent orders against the company, stemming from a sales scandal that publicly erupted in September 2016. 2 of those consent orders will be terminated in 3 years if Wells Fargo confirms to regulators that it had made the required fixes. In 2020, the Office of the Comptroller of the Currency, or OCC, banned former Wells Fargo CEO John Stumpf from the banking industry and fined him $17.5 million to settle charges he failed to put an end to sales misconduct. Wells Fargo's management team and board have changed dramatically since then, implementing a slew of incentive and risk management procedures. Sharp became CEO in 2019, the 4th person to lead Wells Fargo since the scandal emerged.
For sure, obviously it affects their earnings, their outlook a little bit. It's a very large amount of money. It's a sort of number that boggles the mind of the average person reading this story. These are very large institutions, with sitting on upwards of about 8 to 10% of the total deposits of the country. So is it existential for Wells Fargo? The answer is clearly no, right? In other words, it doesn't imperil the survival of the bank or its ability to continue to do business. It is big enough, though, to show up on the radar as a penalty that means these things are not worth sort of indulging in a bank. And we have had problems in the last bunch of years of $1 million fines for $1 billion boondoggles. And the problem for the public is if the fines are smaller than the gains, the signal being sent by the regulators is confusing to the financial management, because it might be that the fines are a bummer, but the institution may be in some financial way better off if it does these things. And so I think in the age of the trillion-dollar banks, of which this is one, you need a larger fine. Otherwise, it doesn't have much of a prophylactic value for the public, because a fine that's a minor mention and a gain that's a major win, it doesn't really make for the right behavioral signal.
Still on international markets, Tesla shares fell nearly 6% yesterday after a string of brokerages cut their price targets on the EV maker's stock, citing the risk from Elon Musk's Twitter distraction. Tesla's shares hit a more than 2-year low of $140. Analysts say investors are worried that Musk may need to sell shares further to fund Twitter, and sentiment around the acquisition of the social media firm could hurt the EV maker's brand. Evercore ISI, which slashed its price target of the company's shares to $200 from $300, said investors fear damage to the Tesla brand. Daiwa Capital Markets also cut its price target to 177 from a high of 240, citing a higher risk profile from the Twitter distraction. Tesla shares, which have lost nearly 60% of their value so far this year, closed down 0.2% on Monday as Twitter users voted decisively in a poll for Elon Musk to step down as CEO of the social media platform. Analysts at Oppenheimer downgraded Tesla's shares on Monday. The price target cuts come ahead of Tesla's quarterly delivery report, expected in early January amid weakening demand in China and beyond. Daiwa lowered the company's delivery estimate by 5% for 2023 and forecast an 8% reduction in revenue per unit year over year. A little bit of news on cryptocurrency. Bitcoin staggered into 2020 year. It ends the year slumped in an alleyway, robbed of its cocktail of cheap money and leveraged bets, shunned by the establishment. The preeminent cryptocurrency has lost 60% of its value, while the wider crypto market has shrunk by $1.4 trillion, squashed by rising interest rates, vanishing risk appetite, and corporate collapses, including Sam Bankman-Fried's FTX. Crypto funds have seen net inflows of $498 million in this year versus $9.1 billion in last year. This is data according from digital asset manager CoinShares, reflecting how mainstream finance has steered clear of the market through its annibus horribilis. Bitcoin hit a record high of 69,000 in November 2021, with the cryptocurrency touching $3 trillion, buoyed by fiscal and monetary stimulus from countries around the world trying to ward off economic damage from COVID lockdowns. But as societies opened, surging inflation forced central banks to tighten rates and led investors fleeing higher risk assets such as tech stocks and cryptocurrencies. Investors pulled money from crypto. Major projects came under strain. The first to crack was Terra USD, supposedly a stable coin, and its sister Luna. The coins sank in value in May this year, with investors globally losing an estimated $42 billion. The shockwaves reverberated through the market. US currency crypto lender Celsius froze customer assets in June this year and revealed a $1.2 billion hole as it declared bankruptcy. Singapore-based crypto hedge fund Three Arrows Capital went bust the same month. But the biggest crypto shock was yet to come. Now we move on to EU. The European Commission said yesterday that it had approved Germany's 34.5 billion euro plan to recapitalize German natural gas trader Uniper. This is subject to future state divestment and management pay and acquisitions. The Commission said in a statement yesterday that the plan complies with the EU state aid rules on the necessity, appropriateness and size of the intervention. The recapitalization involves an immediate cash capital increase of 8 billion euros, which will be subscribed at a price of 1.7 euros per share. It also approved authorized capital of up to 26.5 billion euros, which Germany intends to pay in stages throughout 2024. The share price, is linked to the difference between Uniper's cost to purchase gas at higher market prices and its price under previous long-term contracts with Russian suppliers. The Commission has said Germany had committed to work out a credible exit strategy by end of next year, aiming to reduce its Uniper shareholding to not more than 25% plus one share by end of 2028 at the latest. And a little bit of news on commodities. We start off with oil, because oil prices ended higher yesterday in a volatile trading session as a worsening outlook for a U.S. major winter storm sparked fears that millions of Americans might curb travel plans during the holiday season. Brent crude futures settled up 19 cents or 0.2% to $79.99 per barrel, while U.S. WTI crude futures settled at 90 cents at $76 per barrel. Oil prices were buoyed by a softer dollar and a U.S. plan to restock petroleum reserves, but gains were capped by uncertainty over the impact of the rising COVID-19 cases in China. A weaker dollar has also supported prices, making oil cheaper for those holding other currencies. According to the National Weather Service, the Midwest and Great Lakes region could see a major blizzard beginning tomorrow, while cold air moving east could bring a flash breeze caused by a rapid temperature drop across the US. Heating oil futures have fallen more than 4% since the start of the week to $3 per gallon on Tuesday. We now take a quick look into the local boss, as my voice is also losing its potency as this show goes on. The FBM KLCI is down 0.49 points or 0.03% to 1,467 points. Gainers outweigh losers at 294 counters in the green, while 246 counters are in the red. Meanwhile, it's a rather slow trading day. At about 9:56 a.m. on Wednesday, 21 December, or 10 days left in the year, the IBM KLCI is looking at about 650 million shares done, valued at a touch under 300 billion ringgit. Some shares include the technology stocks, as well as companies like Green Packet, which is down half a cent to 6 cents. Berjaya Corp is down half a cent to 28 cents. Serba Dynamic, which has been in the news recently because the SC has said that because of its failure to produce the 2022 annual statement, Serba Dynamic will be delisted this year. Serba Dynamic has reached a high of 4 ringgit at one time, or even 5 ringgit if my memory serves me correctly. Well, this morning Serba Dynamic is at 1 cent. 1 cent, Serba Dynamic. Okay, some news when it comes to the economic news of Malaysia. Malaysia's trade expanded 15.6% year-on-year to 238 billion in November 2022. Meanwhile, the government, i.e. the Malaysian government, plans to spend 107 billion ringgit from the Consolidated Fund to fund the government services in next year. Petronas, meanwhile, sees a stable activity outlook but expects energy market uncertainty to continue on for the oil and gas sector. Meanwhile, total passenger traffic in Malaysia has hit 15.6 million in the third quarter of this year. This is the highest since COVID-19. I'll be elaborating more very shortly. Meanwhile, Yinsen gets another contract extension worth about 15 million ringgit for Adun FPSO. And Kawan Food cancels plans to purchase Selangor land plots for second manufacturing plant. A quick note on the tech sector as well as the telco sector. Digi Business expanded partnerships with Petronas to improve the latter's offshore platform connectivity. Okay, as promised, we're looking at the TIV of the car sector, or the total industry volume of the car sector, because this is indeed going to be an interesting sector to look at for next year. TIV in November this year grew 6% month-on-month, driven by robust backlog orders and an easing component and parts shortage situation. The first 11 months of this year's TIV jumped 45% year-on-year. CGS-CIMB expects a new record of TIV of 695,000 for the entire forecasted of this year, which is going to be up 37% year-on-year, but a lower 640,000 TIV in next year or 2023 forecast due to SST holiday expiry and rising interest rates. CGS-CIMB stays sector neutral with some companies like Burmas as their top sector pick. I wish you all the best. 10 days to go before we conclude this year as I continue to nurse my voice from shouting at the Argentina-France game. My name is Ibrahim Sani. All the best to you.